And after this 2 weeks of period, welcome to Blockrevision episodes, your regular dose of the most important and the most updated informations of stock and crypto markets. These are the informations that may impact the biggest changes around these both sectors. And these are the things that could make a pivotal change on where the things were going by now. So it's very interesting to approach this kind of issue, and I am very happy that you are staying with Blockrevision. So today I have a special episode that I'll be recapping within the most important aspects of things that happened during recent 2 weeks period of time since 20th of August as we have ended our broadcast back then by today. So I don't want to omit any single important news that may impact the future performance of markets. So stay tuned, let's get into it. And as standardly in the beginning of our episodes, I'll be commenting the most important events on the economic side that had an outstanding outcome for both analysts and investors. So these are the events that were hard to predict in its result and had some impact on the changes of where the markets has gone. So let's begin. And on 20th of August, we had retail sales month over month. This is the gauge that has recently dropped by 2.5% from a month earlier in July 2021. And as we can see, it's the most since January and is missing market expectations of 0.6% and has increased as rising COVID-19 cases, Euro 2020 soccer tournament, and also bad weather that forced people to stay at homes. So afterwards we had important gauge from Canada, also retail sales that the same day. And instead of Great Britain, this retail sales has jumped since recent ratings that appeared to be at minus 2.1%, and it's as we can see, it's the first increase in 3 months after public health restrictions which limited non-essential retail activities were eased in many regions across the country. Okay, let's get to the next gauge, and the very important one was market manufacturing PMI flash from Australia, and this one was also surprising in effects. This gauge has surprised to the downside. As we can see, it's a major slump that is showing us still above 50 points level, but right now Australia is struggling with both demand and production that has fallen for the first time since June 2020, and also Australia has recently struggled with the extension of mobility restrictions, including strict lockdowns measures across various Australian states. As of next, we had from Great Britain market CIPS UK services PMI flash, and it slumped from 59.6 points. So as explanation, both services and manufacturing sectors grew at the weakest rates for 6 months in Great Britain amid reports of shortages of staff and raw materials. As of next, from US, we had also market services PMI for August, and this one also has slumped, and this one exactly bounding from a downwardly revised 2% contraction in the first 3 months of the year, supported by private consumption and state spending after COVID-19 restrictions were eased. And afterwards, we had initial jobless claims from US that surged from 349k to 353k. That is a pessimistic outlook for market, for the labor market. But that was on 26th of August. Let's look at another gauges that were a little bit more optimistic. But first, let's talk about Jackson Hole Economic Symposium that we were foretelling as important for the US economy. Meeting where the most important key aspects will be led out by Fed Chair Powell. So during this meeting, Fed Chair Powell signaled that central bank will likely begin tapering before the end of the year, although the reduction in asset purchases will not carry a direct reduction in asset purchases. So it's also remarking that Fed will continue to hold the target range for the federal fund rates at its current level until the economy reaches conditions consistent with maximum employment and inflation has reached 2% and is on track to moderately exceed 2% for some time. As of 31st of August, we had another outstanding gauge that was GDP growth rate from Canada quarter over quarter that has contracted, and it means that international supply chain disruptions have constrained imports of parts mostly for the auto sector and led to a 4% decrease in exports. Right now, let's have a look at 2nd of September and PPI month over month from Euro area find its rating at actual 2.3%, and that means that in July 2021 we had noted the largest monthly increase since January 1995 and well above market expectations of 1.4%. So right now it is adding obviously to signs of inflationary pressures, and among this gauge we can find that cost rose for all categories: energy 5.7%, intermediate goods 1.9%, durable consumer goods, capital goods, non-durable consumer goods. So it's something that is worrisome to EU politicians. And after this previous week troublesome gauge of initial jobless claims, all eyes of investors was turned to this event, and afterwards we found it's more optimistic than recent gauge, and right now we are sitting at 340k relating to 354k noted previous time. Another important factor that is worth watching was Caixin Composite PMI from China that is contracting very rapidly. We have turned to below a 50 points level. That is meaning that we are getting into trouble in terms of rebounding the economy since this pandemic times. So as we can find here, Caixin Services PMI has plummeted to such low levels, and it's due to that government imposed stringent restrictions on travel during the peak summer holiday period to contain an outbreak of virus cases linked to the fast-spreading Delta variant in some parts of the country in August. Let's look at next ratings from US non-farm payrolls that added 235k jobs in August of 2021, and it's the lowest in 7 months and well below forecasts of 750K, as a surge in COVID-19 infections may have discouraged companies from hiring and also workers from actively looking for a job. So that's something very pessimistic for US economy. Definitely there was one surprising gauge that even with this lowering ratings of initial jobless claims, this non-farm payrolls is really hitting the optimistic outlooks, and right now it's turning again some pessimistic vibes. On Tuesday, 7th of September, we had RBI interest rate decision that remained stable at 0.1%, and afterwards we had also important for the Germany ZEW economic sentiment index, and expectations of these ratings fell markedly once more in September 2021. Although financial market experts expect further improvements of the economic situation over the next 6 months, the expected magnitude and the dynamics of the improvements have decreased considerably. So right now, Germany is struggling with global chip shortage in the automobile sector, and also shortage of building material in the construction sector. And these are the gauges, these are the things that have caused a significant reduction in profit expectations for these sectors. So in order to sum up, the private payrolls numbers have been over the map during the pandemic. With so much pressure on improvement on the labor market front coming from the Fed, this could send a signal that jobs growth is stagnating. That's likely a good thing for the markets, though, as it means that this easy money policy can continue. So the latest US jobs report through traders' calculations hourly after they braced for an announcement of tapering at the Fed's September meeting. So right now, the world's largest economy added only 235,000 jobs in August, and it's the smallest gain in 7 months, boosting chances of a delay in that announcements. So expectations of a delay in Fed tapering, as well as new administrations in Japan, is supporting equity markets and is expected to continue. And right now let's get to economy view. And undoubtedly one of the most important events of recent 2 weeks was this Jackson Hole Symposium meeting, in which we haven't found anything special, as I have mentioned before. So it hasn't brought an abrupt change in monetary policy, and right now also Fed has emphasized that even if tapering will commence in the coming months, it won't automatically mean that central bank is on a glide path to rate hikes even in 2022. So looking at the labor market with problems as it has, and with lots of things need to be sorted yet, we don't expect Fed to hike its interest rates even by 2022 if this COVID restrictions will increase within next months. So Jerome Powell is awaiting for the labor market to improve in terms of non-farm payrolls, and also in terms of initial jobless claims to get back to at least 250K, I guess. So it could take within the next chaotic period throughout the fall and winter, because it's COVID issues will take maybe over 1.5 years. And something that was out loud within a market space and is really worth mentioning was these problems with Evergrande company. Evergrande is a second biggest by sales property developer in China, and Evergrande right now has a liquidity problems. Liquidity in terms of the downgrading its bonds to AA from AAA, so the ratings of bonds is slumping, and right now the company and its bonds are being placed on a watch list for further even downgrades. So it's something that may be worrisome to other property developers. We can find that this market is working as a domino, and with one big company has its problems, serious problems with liquidity, the other smaller companies will may have even bigger problems in the weeks to come. So right now, Evergrande bonds has trading has been halted on the lots of exchanges, and right now we can find it as a problem where we would like to study of how Chinese markets impacting the US, the United Kingdom, the EU. It may be something as of no insignificance to other sectors. So we need to take a look at what will happen. What would happen next? As that could be even a like a Lehman event in terms of property developer sector, and also we need to be very cautious in terms of watching and expecting even higher home prices, because that exactly may be a pivotal moment to a property market. And not only property market has its problems, also we're suffering from a lack of confidence among consumers around either Canada and also China. So we can find in Canada that consumer confidence slides for third straight week, and this exactly is a chart. So we hadn't had such a slump since July of recent year. Is that just a correction? Time will tell. However, after such a recent surge, we